All right, we're back for the February version of the monthly economic update. I'm John Cleaver, partner and senior financial advisor.
I'm Dennis Bacon, Chief Investment Officer at Beyond Wealth Advisors.
We're excited to be back, and we're into the second month of the new year. And so what we're going to do today is, you've often heard Dennis talk about the difference between sometimes the economy and the market. And with the start that we've had to this year, we thought it was appropriate to kind of address those two things separately, and then we're going to come back at the end and kind of bring it all together and talk about where we go forward from there. So to get started, maybe just focus on the economy first.
Okay.
Where's the economy go from here? How do we move forward? What's that look like?
Okay. Well, probably the big drivers in the economy right now are the inflation issue.
Absolutely.
It's actually the highest it's been in 30 years right now. And the Fed is finally coming to realize that that's the case.
Right.
They've announced that they've said 5 interest rate increases for the Fed funds rate, which is the base level of interest charged in the economy. And but I expect 4 to 6 over the course of the next year. But you know, that's kind of the bad side. The good side is the gross domestic product, the growth of the economy was great in the fourth quarter, up 6.9% quarter over quarter. And the U.S. manufacturing continues to expand, as does Europe. And even China, which has been lagging, is slightly positive. So those things are real good. And consumer confidence is actually high, slipped a little bit, but still well above, in the expansion mode.
Yeah. So if you had to give the economy a grade for where we're trending, your wife's a teacher.
I would say it's trending positive.
Yeah.
But there's still just a lot of headwinds.
A lot of headwinds.
But we don't expect anything highly negative in the coming year.
Absolutely. So let's talk a little bit about that. Those headwinds often manifest themselves in more of the form of the market. Market's been a little wonky lately. What's happening? What are those things?
Well, we're in a transitory time right now. We are moving into a time with higher inflation, and the bond market experienced probably the worst bond market it's had in about the last 5 years in January. The 10-year Treasury has now increased to pre-pandemic highs.
Right.
And so go back a couple of years. It's actually probably really been the worst month in the market since about 2020, and 9 of the 11 sectors of the S&P were negative, the worst being consumer discretionary, which kind of has some implication on what consumers are actually doing, because by definition, consumer discretionary. But the reality is there's some underlying things that they're buying that are a little bit more base need things that are just costing a little bit more. But on the good side, we've had some really good things. And this is part of that transition that we've talked about. Commodities have done great in the last month. Matter of fact, the best year in commodities since 2010, except for precious metals. So those people who talk about precious metals as the place to hide was not the place to hide in January. Oil is at the highest it's been since 2014.
We hear a lot about that.
Yeah, we expect it to actually continue to increase, maybe another 10% or so. And if we have some disruption in Russia and Ukraine situation, it could cause it to go a little bit more. The other thing that people don't realize is the housing market is hitting on all cylinders. The only thing holding it back a little bit is the whole supply chain issue, which we've talked about. We're not going to really talk about that today, but that is still kind of laboring a little bit on the actual completion of projects and getting those things done. But the number of contracts, the new houses being built, the new permits being issued are really doing extremely well.
Well, that is a positive as we, as you say, transition through into this kind of new cycle. So, all right, going forward then, bring those two things together. What's the expectation for the short term and however long out you want to go?
Well, I think from what you're doing in your portfolios from an investing standpoint, I think on the bond side, because of rising interest rates, we know bonds are going to continue to suffer some. We're really shortening, getting really short-term bonds. Or if we want longer-term bonds, we're going out on the credit curve, meaning things are a little bit more risky because the economy looks good.
Right.
And so the high yield bonds and stuff usually don't have a problem as long as the economy looks good. Now, granted, they still may go down in value, but because they have such a high yield, it'll offset that. So
Makes
it
sense.
still is a pretty decent place to be. The commodities are a great place to be.
Talked about that.
Energies and industrials. Stay away from precious metals. They're not going to look all that great. They're okay, but they're not going to.
Sure.
They were down 2% in January, while everything else is up 3 to 5, and energy was up 20%. Don't expect that to be every month. But I would say that's kind of where we are. On the equities, we're seeing a rotation away from the high PE stocks. Now, the companies are going to be great companies in the long term, won't suffer as much as what we might think they will. But the ones who don't have really that good a profit, we're trading a PE multiple of 300 and stuff like that. I can name some companies we won't here. But those are really presenting challenges. The places where you want to be, which will protect you a little bit in the high inflation areas, are commodities, particularly energy, but also that goes to the consumables, all of the food source economies type things. Industrials are really good during this time period. Consumer staples and financials. Utilities sometimes are, but with the interest rate increases, utilities are probably a little iffier in that area. So a shift toward the value side.
I was just going to say, any comments about growth, value, almost that dividend paying type stock versus, the growth, high engine stock.
Well, all of those categories I just named are all by definition on the value side. Now, it doesn't mean growth aren't still going to do okay, but the rotation is going to be the bias is a little bit towards value. Their price earnings multiples are much lower than all the growth stocks. So we're going to see that catch up phase, if you will, and so there'll be a little lag on the growth side. If we have a deteriorating economy, then the growth side could face real problems.
Sure.
So,
well, we certainly don't want that anymore. We had a little bit of that to start the year.
A little bit,
but,
not much, but a little bit.
It's also not completely unexpected.
Right.
We've not had that type of pullback for some time. So,
well, one interesting thing too, typically in a first election cycle after a new president, typically there's a pullback of around 19 to 20% in the market at some point in time during the year. So we still expect that volatility. These moves typically won't be less impacted by that volatility. So that's just one thing to kind of look at. There's a lot of factors.
Right, absolutely. All right, well, that puts a wrap on February, and it's been another great month. We look forward to seeing you again next month. Be sure to reach out to your advisor if you have specific questions, and start doing that planning for 2022. See you next time.
Thank you.